This week we're going to do something different than we've done before for Dukascopy because we're going to concentrate on one and only one market for the few minutes that we have together. Which one is deserving of our entire time? Well, I'll tell you, it's a market that topped out months ago despite the fact that most technicians on the street are quite bullish and most who are fundamentally oriented are quite bullish. The market is the gold market. What we're going to do is take a look in a step-by-step process, technical study by technical study that I think is meaningful, along with some other information, and give you the conclusions that we do about gold, why we got out where we did, and what we're looking for now. So stay tuned.
Let's take a look first and foremost at one of the most important things that I've looked at for months now, and that is the Commitment of Traders report for the gold market. And most importantly, in this last week, and a new report will be issued tomorrow, Tuesday the 26th of November, but as of last week, this is what's really important to us. The speculated longs, that's managed money, added another 12,000 contracts on the long side. That brings them up to 222,000 contracts long versus only 27,000 short. Other reportables, which are essentially small specs, not big enough to be in the managed money category, added 1,744 longs last week. Now they added more shorts than they did long, but the net effect here is that speculators added or reduced shorts, both large and small combined, by over 19,000 contracts since the prior week. The ratio of contracts long to contracts short is about 6.5 to 1, long versus short. That is a huge mismatch in positioning by speculators. It means they're very long, and as we said, they actually added more on the decline that we're seeing, making them even longer. So now let's switch to charts. The first one I want to show, actually, before we get here, let's look at let's see, is it going to let me? Here we go. Let's look at the long-term chart. So the uptrend line from the 2008 low held in 2018 for all practical matters. I got clients long at $12.95 back in March, so somewhere right in here we had about a $20 decline against us over time in order to play for what I expected to be a breakout to the upside. We got the breakout in the summer of 2019. There's no one specific level, but clearly between 1350 and somewhere around 1375, 1380, going back years, we broke through all those important highs and we zipped to the upside. We had for clients a target of 1487 to 1532 to exit the gold, and we actually got out at 1491 and a half, so we were just shy of a $200 profit in the gold that we had bought in early spring earlier part of this year. And you can see why I kind of created this 1487 to 1532 target. Once gold had broken down in 2013, the last high it made was 1487 before it fell precipitously. Where did it break down from? Well, just about 1532. So that was our target for this trade. Even though we got as high as 1559, the highest weekly close we saw this year was 1526. So getting out at 1490, we missed $30 or so for maximum weekly close that we could have gotten. We've been flat gold now for months. What we're seeing now, and now it's easier to switch to the daily charts, are the following. So let's start here with just some basic trend lines. From the 2018 low, clearly we're still above that. What's happening now is we're starting to poke through the gap up that we saw in June, and that trend line shown here in purple is really starting to break. Obviously there's a downtrend line now from the highs. So the first thing here already is, to me, knowing how long the market is from speculators, we're seeing some downside pressure. And this is part of why I've been unwilling to get back into gold. Secondly, let's add something like the cloud chart. The cloud chart broke a few weeks ago. We're underneath the cloud, the lagging line's underneath the cloud. In the daily time frame, this has gone into full-scale bearish mode. There's nothing bullish here in the shorter term time frame about gold using the Ichimoku cloud. What else can we add to it? Let's take a look at time to mark sequential. And this is the aggressive sequential setting. I'll actually take the cloud off just to make it a little easier to see. And for those of you who are not familiar with this model, when we find 13 counts, and I'm not going to go into how these counts come up now, if it's above price, it looks for upside exhaustion. If it's beneath price, as it was, for instance, here in April, let's see, there we go, it says downside exhaustion. What do we have in September? Upside exhaustion. Another reason why I've been unwilling to go after gold here. What else can we add to this that we look at and work with institutional clients especially on how to more specifically time this? Well, another DeMark model is called propulsion. And breaking underneath this kind of, we'll call it deep maroon line in here, would suggest, if it's done properly, and it still never did to actually get a short signal, but it targeted 1467, which we already hit, and potentially down here at 1417 or so. So that's what I'm looking for on the downside, perhaps something as much as 1417 to even begin to think that I want to come back in. Now, if I put on the near term, there's another propulsion target that we're, momentum level that we're just starting to break underneath, and that suggests a move to 1430, 4.5, 1435. So that gives us about a $20 range between 1435 and roughly 1415 as downside targets, and a place that if I'm going to get back into gold, that's likely the area. But I'm not going to do that until I see speculators getting knocked out of the market. Again, with a ratio of 6.5 contracts long in the futures markets for every one short, there are still far too many speculators who are long gold. And despite the fact, if we go back to the original weekly chart, if we look at the low, it was down near 1050 back in December of 2015. And most tops ended up somewhere around 1375. That's a $325 range that gold stayed in for years. When it broke out to the upside above 1375 in the summer, if you add $325 to that, you get $1,700 gold as a target. And ultimately, that's where I think gold is going. But I don't think it can get there when this many speculators are long gold. And the trade is short, but they're short at a different ratio, one that's much more tolerable and manageable. And we've got to see the open interest shift dramatically to get shorts covering their shorts, which is trade, and the longs getting knocked out of the market to the shorts covering. And when we see open interest decline, and we know that both sides are exiting the market, then gold can regroup and have the chance to move in another leg higher to 1700. If you're long gold north of 1500 now, and you're long, especially if you're long futures, you're hurting. Gold is 1453 as we talk right now for the December contract. So that's the scoop. I hold off buying gold. I wait until longs get knocked out, and as they're done selling, as best as we can tell, we'll then start to look to step into gold for another bigger move over time. Well, that's it for this week. I hope you enjoyed this. For Dukascopy, I'm Rick Bensignor, and also for In the Know Trader. Bye-bye.